Welcome to this Killick Explains Finance video. This week, part one of property or shares. A big debate: do you put surplus capital to work in the stock market or do you put it to work in property? So, with no more ado, in summary, there are actually some good reasons to own your main home, and I wouldn't stop anyone trying to achieve that objective. Security of tenure, you can't be kicked out, and in this country, the rules in terms of balancing up landlords and tenants in rental property are not as favourable towards tenants as they could be, and indeed are elsewhere. Freedom to change it. Once you own your own property, you can extend it, refurbish it, repaint it within reason. And the CGT exemption, the fact that your first and principal main property is capital gains tax free. No matter how big the profit you make on it, there's no capital gains tax to pay. And on top of that, if you can enjoy other properties and you're lucky enough to be able to afford them, holiday homes, for example, homes for your children, great. But there's a clue in what I said there. If you're buying property to enjoy it, live in it as a family, great. Beyond that, is property really a better way to use your lifetime savings, as we call them, than shares? Well, let's have a look. Now, first thing to think about is, what period am I investing over? Whether you pick property, whether you pick shares, you are talking about a long-term investment. Neither is appropriate as a short-term investment. Now, the long term is getting longer. Girls being born today, a fact I've mentioned before, are expected to live on average to 100 years, according to the Office for National Statistics. That's climbing all the time. So a 40-year-old, let's say, alive now, could easily expect to be working until they're 70. I suspect the state retirement age will have moved to 70 by the time they get to retire, and may well live to well over 90. Middle age is therefore the new youth. Now, what this means is we need to take a long-term view of property and shares, and also recognise that as final salary defined benefit schemes disappear, as the state contracts, people have got to take more responsibility for their long-term welfare, personal responsibility for their long-term welfare. So where are you better off investing? Let's take a look. And we're going to use a long-term time horizon here. Let's wind the clock back a good 40 years and think about whether the past could tell us anything about what we should do now. So here we go. In 1971, now I've gone back a little bit more than 40 years, some of you will have spotted, and the reason for that is I want to go back to a really, really bad time for stocks. I'm going to go back to the beginning of one of the worst crashes in the stock market we've seen in recent history, the 1970s bear market. All right, back then, the average UK house cost around £6,000. So let's look at a property investment, let's say, or a typical property investment. Now, winding all the way forward to actually the first quarter of this year, that average UK house costing £6,000 will have climbed, not inflation adjusted, in pure nominal terms, to more like £188,000. So a £6,000 investment, capital only, ignoring rental income and so on, climbs to £188,000. Not bad, you might say. That's the average price compared across that just over 40-year period. So how would an investment of £6,000 in stocks look? And I'm going to pick the FTSE All-Share as my index rather than the rather sort of narrower FTSE 100. So if you put your £6,000 to work at the start of one of the worst bear markets we've seen in recent stock market history, or say recent over the last 50 years, a stock market entry point where almost immediately you'd have seen 2/3 of the value of your investment wiped out. So I'm not exactly being biased towards shares here. How would you have done? So £6,000 goes in, the start of that 70s bear market, wind forward to the same point I just compared with property, and you'd be at around 110,000. Well, that's not as good, you might be thinking. So 1-0 to property. But I've missed something fairly crucial, and that is the fact that shares pay dividends, and reinvesting those dividends over time significantly increases your returns from the stock market. And that's not something you can do very easily with property, by the way, this reinvestment thing. So taking the all-share total return, that's capital and income, how does the picture change? Same starting point, same end point. Well, now we get a rather different picture. Winding forward, there's a £6,000 investment, remember, back here. Winding forward, we climb to a rather more impressive 650,000, more or less, rounded a little bit there, and that's a much bigger gain from stock market investing over that period. So what does that look like? Let's condense that all together What does that look like? So on a nominal, that's not inflation adjusted basis, basically, if you get your timing badly wrong in the stock market, now no one knows what the stock market's going to do next, so you might get it wrong, you might get it right, but if you've got it badly wrong, let's take a look at the multipliers. In other words, how many times would your capital have grown on a nominal basis since, if you like? So 18 times for shares, capital only. 31 times for property, capital only, 1-0 property, but 108 times for shares if you factor in dividend reinvestment. This is pre-costs, yeah, but factoring in dividend reinvestment over time. Now, let's say you were lucky enough to get your timing right in the stock market. Let's say you managed somehow, because frankly market timing is almost impossible, let's say you managed to get in right at the end of that bear market, right at the bottom of the market, and then the stock market climbed out of that sort of horrendous 2/3 loss dip. Well, now the picture changes quite significantly. Your initial capital would have multiplied around 53 times, comparing the start to the end of the previous graph. Property 19, not bad, but with income reinvested something like 260 times. Okay, so you can see the power potentially of stock market investment over a long period of time, reinvesting dividends and employing one or two other strategies I cover in other videos, like making sure you don't have lots of single stock risk in there. You're not force selling, you're not panic selling in the dips, the usual rules that we apply. So there we are. The total return from shares puts them some way ahead. Now, were we to take a slightly longer look back still and use data from the Barclays Equity Gilt Study, what do we discover? Are there any sort of hints and tips we can take away about this property versus shares comparison? Well, here's recent times. Because people might be thinking, well, recently property's done pretty well, hasn't it? Yeah, recently it has. So with a low inflation rate compared to what you see over a sort of previous 50-year period, and inflation's even lower than that average period between 1995 and 2010. It's down near 0 at the moment, but that's not typical for the UK. Yeah, this is real post-inflation returns. Property beats shares. But that's over the relatively recent past, a fairly unique period. And basically, were we to take a longer look back, and the past is no guide for the future, I'm not saying this is going to happen again in the next 50 years, but let's use history as a guide, then we see that on an ungeared basis, property has actually quite significantly underperformed shares, both in that period and also in this period. And we notice here that we're applying what long term have historically been more normal rates of inflation. So the key to some of that property performance has been relatively low for the UK levels of inflation. All right, but over the longer term, 6.9% as an average real rate of return beats 2.4. And if you're thinking, well, hang on a minute, you can gear up property. You can use debt to enhance the return from property. Well, yeah, but the problem is, as I'll show in the next part of this series, that can work against you as well as for you. And also we've got to compare apples with apples. If you could gear up your equity portfolio, then clearly this number would jump even further. Okay, so you have to compare like with like, so ungeared property, ungeared equities. Now, point about inflation. Where's it going to go next? Nobody knows. At the moment, it's close to there, almost 0. But the point is, you can see historically, not so long ago, it was way up in double digits, and people have sort of forgotten that. The UK's history of inflation is not 0 inflation. It's something much higher. Over the last 50 years, more like 5%. And if inflation kicks up, then we might see a return to some of those returns I mentioned over that 50-year period just now. It's a big debate. All right, so in summary, for part 1, let's say both property and equities have proved their worth as long-term assets, not to say they haven't. But the total return from shares, key there, has regularly beaten property. And as I'll cover in part 2, shares are an easier asset class on top of that to manage and own. And I'll make some points in part 2 to explain that. So, in summary, do aim to own your own home, and many people do. If you can afford to own other properties you're going to enjoy, buy those too. Lucky you, yes. But beyond that, I would put the bulk of my savings to work in the stock market rather than some buy-to-let portfolio. Any questions on what is a big topic, please email to the usual place, and in part 2, I'll take on some of those points I just made a little bit further.